This report reveals an insanely strong case on why just 5 companies will crush the market for years to come. And it has everything. Stats, charts, theories, and above everything else, a pivotal argument to why big hedge funds are helpless to take advantage of this massive opportunity, leaving it open to retail investors just like you. So let me take you through this report to tell you everything that you need to know, and I'll even finish off with my very own tier list to prioritise these 5 different stocks, highlighting which ones I think are your best bets between now and the year 2030. Before this though, there is something that you need to know. It might come as a shock, but my dog cannot give financial advice, just like I can't. And when investing, your capital is at risk. No, not that capital, you idiot, this capital. So make sure you do your own research. With the disclaimers out of the way, let's get into this report. Once we remove the completely self-made clickbait title page, it reveals a report by Nayut Sitachit titled The Systematic Undervaluation of Big Tech, and boy is it a great read. Nayut breaks down his thesis into 5 broad arguments. The first is that we're actually living in a new age of investing. Big tech companies have completely changed the name of the game by being monstrous aggregators in the market, which is a fancy way of saying that they can easily grow and take up lots of market share as compared to normal and more traditional companies. Think about it, even the biggest grocers or quick service restaurants struggle to break out of their home country geographies. Even though they are by far the best at what they do in the world, the simple barriers of moving geographies is simply too difficult to succeed. It's the reason why we aren't all shopping at Walmart, but it's the reason why we're all using Google. Nayut highlights the corporate competitive landscape back then, so referring to the 1950s, was far more intense, i.e. fewer winners take most outcomes. And without the internet, the largest companies in any given market weren't able to aggregate demand the same way as our current big tech companies do. With the example being that there used to be thousands of wide moat TV and radio stations soaking up all the advertiser money. But if we skip forward to today, over half of this demand is just pulled into 3 different companies: Google, Facebook, and Amazon. He also points out that these new aggregators have very different relationships with their competitors as compared to companies in prior decades. In grocery, for example, customers will tend to shop at one or the other, not both. Where with tech, you are far more likely to have both Netflix and Disney Plus, as they are complementing products, meaning that concentration risk isn't nearly as high as other businesses. Basically, it's far less of a zero-sum game. These are all the fundamental reasons why big tech is creating a new world order, and the reason why we need to have a new view on what a new age company looks and acts like. Nayut then goes to prove that these benefits are not being reflected in their valuations. In this table, he then breaks down Apple, Microsoft, Google, Facebook, and Amazon to their adjusted multiples based on only their core businesses only. So stripping out any costly side ventures which they are investing heavily into, which results into some wildly low multiple valuations, especially considering the strength of their businesses. I've got to say, this really blows my mind. Based on these valuations, Google and Facebook would be cheaper, yes, cheaper, compared to companies like Procter & Gamble, Coke, and McDonald's. And you've got to think, all of these 3 companies are growing at less than 10% a year for the last 5 years, and Coca-Cola's actually been declining. To show how insane this is, he then plots these valuations against their growth over the last 5 years. Growth on the y-axis and the trailing 12-month P/E ratio on the x-axis. And this line that I'm drawing here, let's call this the shit to stonks line, showing low growth, high valuation companies in the bottom right-hand corner, like Nike, MasterCard, PayPal, and MSCI, and in the top left, high growth, low valuation companies like Facebook, Google, Apple, and Microsoft being complete stonks. Just look at Facebook, for example. It has 25 times the growth of a McDonald's at half the valuation. Nayut calls out the fact that the most common cited criticism of big tech from a risk point of view is regulatory risk, which he believes is massively overblown and doesn't justify their current discount. On top of this, he reiterates that even if they were broken up because the government thought there was some kind of monopoly, one of these smaller chunks of businesses would likely be a key aggregator and would take up most of the demand just as one. And if I'm honest, that was probably the least interesting part of this report. Wait till you hear about this. Nayat then lays out 4 systematic reasons why big tech is so undervalued. The first is that the governing rules around portfolio management are massively outdated. Asset managers are currently working on acts from the 1940s, which dictate a soft cap of 5% on their largest positions. It's a bit mental thinking how portfolios can be governed by the norms of the 1940s, considering that big tech's only really been around since the early 2000s. If their portfolio breaks these rules, then they're actually prevented from being able to claim that their portfolio is well diversified, which very few are keen to do. But you might think this only causes a problem by the fact that they can't buy more shares if they wanted to, but this is incorrect. It actually gets worse, as it means they're actually influenced into trimming down their positions. In this simple chart, Nayat demonstrates that the weighting of big tech in mutual funds has been declining over the years. You can see back in 2016, or towards the end of 2016 even, we were currently at parity, meaning if the market was made up of 10% big tech, then mutual funds were holding roughly 10% of big tech. Well, you can see that ever since this point, it's plummeted over the last 5 years, hitting an all-time low of negative 555 basis points, which in the real world means they're underweight big tech by 5.5%. This means mutual funds have been net sellers of big tech over the last 5 years, putting downwards pressure on their stock price, causing significant undervaluation. Next, he looks at the current incentives in the hedge fund industry. It's no secret that people are influenced by incentives, and fund managers are no different. But this forces them into making bad choices and overlooking big tech. Why? Well, Nayat highlights that any fund manager worth their salt wouldn't be caught dead buying well-known and well-researched companies like big tech. Think about it. Imagine paying somebody 3% a year and they end up putting half of the money in Amazon. You'd feel pretty ripped off, right? Why are they charging such high fees if they're just going to choose obvious companies like big tech to invest your money into? You'd want something a little bit more obscure like a mining company or some funky nanotech company, for example, and feel like that these people are spotting the diamonds in the rough for you. Well, due to this situation, they are forced into the impossible game of finding the hidden gems out there. Companies which are lesser well known, making it look like they have some kind of super knowledge that you're paying for. But Nayat highlights how incredibly difficult this is to outperform the market in this way. 1, they are forced to underweight the most undervalued shares in the market, so big tech. 2, they are overweighting shares from a group of companies that as a whole have underperformed the market, at least historically. And 3, they need to outperform the market after layering on their fees on top. And to highlight how hard that has been to do, just look at the last 5 years' performance. Since 2017, big tech has consistently beaten the remaining S&P 500 over this time period by an average of 3.5% every year. And good luck beating that performance without big tech. As Nayat puts it, it's like playing a computer game on hard mode when easy mode wasn't that easy in the first place. This lack of purchasing from hedge funds only pushes valuations even lower. To hamper their valuations even more, Nayat goes on to explain that there is only a limited amount of growth dollars available, basically meaning that there's a lack of cash compared to their size. Remember, there has never been an era like now where such companies have got so big, where they're now worth trillions of dollars and they're not even mature yet. It's hard to fathom how a company worth nearly $2 trillion could easily double in the next 2 years. And that's what's hard about attracting investment. They look like mature companies from a market cap point of view, but they're still acting like growth companies, which established investors do not like, as they don't offer niceties like dividends, for example, or things like share buybacks. This section of non-growth purchases is believed to be as big as 70%. This means when companies are this big and grow a further 20%, it's really hard for them to match this by getting that 20% uplift in their valuation. But this is likely to change, as these big tech companies will mature at some point, and at this point they will want to hold a broader appeal to investors. And these tactics include being more capital efficient, having stable and increasing earnings, offering growing dividends, improving the price per share, having lower volatility on their core business, a bit like how Amazon isn't doing, and putting limited capital investment into moonshot projects. A great example being Facebook's ludicrous investment into Metaverse, for example. Further to this, these companies could go further by committing to larger share buyback schemes. As these companies are systematically undervalued, this will be a great use of their capital to buy their shares back, rewarding long-holding shareholders. So, based on this report, where would I put these 5 companies in a tier list as for potential for their returns in the market over the next 5 or 10 years? Let's start with Facebook. For me, considering this report, which remember was published on the 20th of January, Facebook since then has dropped a further 33%. Yes, they have had their first decline in Facebook users for the first time in their 17-year history, but even then, I can't see how this isn't insanely deep value territory, especially based on the fact that their other businesses are doing incredibly well and Facebook is improving in profitability every single year. For me, this has to be S tier. Next, we have Apple. Out of this bunch of big tech, I think they're definitely one of the safest bets, but equally, I don't think they have as much upside as the others. They're already appeasing investors quite a lot with share buybacks and their recent stock split. So for me, I think they should be in B tier. Next, let's talk about Amazon. Amazon for me are one of the biggest ballers in big tech. They really do not give a flying F what investors think and are making little to no efforts at appeasing them. Nayot even highlights in this report by saying that Amazon does little to appease more conservative investors. And he's not wrong there, and gives several examples of them actually not paying a dividend, providing zero disclosure on moonshot investments, and then on top of that, they invest heavily in their core business rather than squeezing cash out of it. So for me, I think there's lots of upside as they don't give a flip at investors, so I'm going to put them in S tier. Next, this is quite a tough one, and it is Microsoft. Out of these bunch of big tech companies, they are by far one of the most established, and for me, they are more similar to Apple than Facebook. They are actually showing a higher growth rate than Apple, but equally, Microsoft is currently at a more stretched valuation, and actually have one of the highest valuations out of all the big tech names. For me, it would be only fair for them to join the B tier. Finally, we have Google, which for me, I like Google a lot, and that's not because I'm just on YouTube. They have a slightly higher growth rate than Apple and actually have a cheaper valuation than them based on their core business. In addition to this, they have lots of projects in the background which people like to forget about, a bit like their stab in the dark in autonomous driving with Waymo. For me, not a very hard decision. It's A tier for me. And there you have it. I would love to know your favourite picks or the companies you completely disagree with the thesis on. I will see you in the comment section. That's all for this video. See you in the next one.